Hello and welcome everyone. My name is Mike Shekhtman and I'm the Regional Vice President for Robert Half. I oversee our British Columbia and Manitoba operations, which includes 3 offices and 5 specialized lines of business. Thank you for joining today's presentation as I'm excited to collaborate with Bryan Yu. Now, before we begin, we would like to address a few housekeeping items. We will be recording today's webinar and it will be available for on-demand viewing, and a follow-up email with the link to the recording will be shared post-event. We also have a Q&A session at the end of the discussion, so please enter your questions using the Q&A box at the bottom of the screen, and we'll do our best to answer as many as possible. Your engagement and participation is also important for us today, as we will have some polling questions throughout the presentation. So without further ado, I would like to introduce Bryan Yu, Deputy Chief Economist for Central One. In his role, Bryan oversees the economic analyst team, and he's the author and editor of many of the research reports and weekly notes. Bryan speaks regularly at the credit union industry events and is frequently contacted by media to provide national and provincial level economic commentary. Now, prior to joining Central One, Bryan worked as a housing economist at the BC Real Estate Association and Canada Mortgage and Housing Corp. He currently serves on the boards for both the BC Paraplegic Foundation and the Canadian Association for Business Economics. I'm pleased to have him with us today to speak about the effect of COVID-19 on the Canadian economy and also the projected economic impact of the second wave that is fully underway. Now, following Bryan's presentation, I'm going to build on a discussion by touching on some of the current compensation and hiring trends that we're seeing, including top concerns for companies when it comes to recruitment and retention. I will also provide some perspectives on what employees are looking for when it comes to flexible remote work, along with their goals and priorities for 2021. Now, before I turn it over to Bryan, let's have a look at the first poll question. So this is where engagement kicks in. Bryan, let's get a quick temperature check from the audience. And the question is, how do you feel about Canada's current economic recovery heading into 2021? So the first option is optimistic. Second one is cautiously optimistic, somewhat uneasy, or very concerned. We'll give it a few seconds for everybody to enter. All right, let's see what the results are. Somewhat uneasy came in with 43%. And right behind it was cautiously optimistic. All right, this is a great segue, and I'm going to hand it over to Bryan.
Great. Well, thanks very much, Mike, and thank you everyone for joining today, and for Robert Half for having me at this virtual session. In terms of the poll question, I think I think the numbers were largely somewhat uneasy or cautiously optimistic. I think that's probably where most people are sitting at this point more broadly as well. I think we're in a very interesting segue right now into 2021 as we kind of look at what's on the horizon for the economy, what's on the horizon in terms of a vaccine, and where that leads us. And that's what I'm largely going to be talking about today. We'll be trying to assess the pandemic recovery that we've seen already and move that into where we think the economy is headed. So for the next slide, please. So I'll be looking at the front end of how we fared from this economic crisis that we saw at the front end of the pandemic from February to April, and really the massive levels of output losses that we saw in the Canadian economy and the labor market, and of course, looking at that also through the lens of that big sharp rebound that we saw in the third quarter. So when we look at the Canadian economy in the next slide, what we do see is that the level of contraction, or it's no exaggeration to say that this was largely a historic year in terms of the economy. We've never seen anything like this in terms of the output decline. If we sort of think back to where it was earlier this year, it seems like a long time ago as we've kind of lived through the pandemic thus far. We're all working from home in many cases. We've seen a lot of layoffs, small businesses shutter. There was a massive impact. When we looked at the pandemic, we had the impact on the healthcare systems, which led to measures to stem the virus. This caused, of course, shutdowns in certain retail industries, restaurants. Depending on where you were in Canada, you either had full shutdowns in some areas like Ontario, or you had partial shutdowns and takeout only in areas like BC, for example. So very different types of policy responses by governments in order to stem the virus spread. But generally speaking, when we look at it through the overall economy, sorry, if you go back one here, if we look at the border closures, physical distancing, we saw a large number of business closures during the period. We had about 12% of overall employment, sort of overall businesses shutter, at least temporarily, during the early stage of the pandemic. Roughly about 50% of these have now come back into have reopened. We also saw various sectoral imbalances as well. If you look at the next slide here, that this recovery phase where we've now regained roughly to about 4%, we were about 4% below GDP levels in February. What we're seeing is that various indicators in the economy have come back quite strongly. It's been a very much of an uneven type of recovery, whereby you have sectors like retail spending largely back to where it was pre-pandemic. And some of this is due to pivoting of companies. A lot of smaller businesses and large companies, they really bulked up on their online sales, even during the pandemic, and that helped to fuel some of their overall store sales. We also saw housing really pick up quite dramatically as well. The housing cycle is now across Canada up about 20% from where it was pre-COVID. What's driving this? Although we've seen the impact of a large-scale job losses during this time, Canada lost about 3 million jobs at the front end of the pandemic. Those have rebounded to about 96% of pre-COVID levels. But we saw mortgage rates drop off dramatically as well, with the Bank of Canada cutting their policy rates and long-term yields falling. People also didn't have anywhere to spend their money at the end of the day. People aren't going on trips or aren't going on vacations. They're not spending on other types of recreational events in restaurants. Well, they put it towards their home. So we did see this large increase in overall housing market activity. We've also seen manufacturing pick up as well, back to where it was. We haven't, in large part, we haven't filled in the gap or to fill in the losses that we saw during the pandemic. But many of these key indicators we're watching have in fact fully recovered or close to full recovery. But that isn't to say that the economy is back to where it was. I showed you in the previous slide that GDP is still sharply below where it was pre-COVID levels. And the big driver of this is the type of sectors or the K-shaped recovery that we've been seeing in the economy. So the next slide here, when we look at this through sort of what sectors have fully recovered and what haven't, well, we've seen things like retail in the last slide, that retail is essentially back to where it was. Housing is, again, has been very strong. You've also seen sectors like finance, insurance, other sort of managerial sectors. Those have all come back and are actually operating above where they were in February. Why is that the case? I think, for those of you who are sitting at home or working from home right now, watching this, you know that you're still employed. And many people have been able to pivot to a remote type of a work environment during the pandemic. There's also sectors that aren't as impacted by physical distancing or social distancing. On the other hand, though, if you look at the very bottom here, some of the hardest hit sectors are the ones that are still the key drag on the overall economy. When we look at the lens of the fact there are no events occurring, there are no concerts, no sporting events. There's global travel is down by 95% essentially in terms of inflows to Canada. When we look at those, we have accommodation, food services, which include a lot of the restaurants, some of the catering, weddings, those types of services. Those are still down about more than a quarter from where they were pre-COVID in terms of GDP. Similarly, when we look at transportation and warehousing, while you do have a lot of Amazon drivers and delivery drivers out and about on the streets, the fact is that the global downturn in travel has meant airlines are not operating anywhere near capacity. And when we think about some of these sectors, you will note that these are very much going to be contingent on the impact of a vaccine or the availability of a vaccine going forward. So again, there's a huge disconnect right now between different areas of the economy. Some people are doing quite well. Others are feeling a lot of pain in terms of the economy. And when we look at this to the labor market, so next slide, well, you see a very similar picture here. I'm showing you here that on the left-hand side, you have Canadian labor force employment relative to where it was in February. As you can see here, there is most sectors are still down from where they were in February, but again, there is some divergence between work from home sectors, utility sectors versus those in the high touch tourism, hospitality dominated sectors as well. On the right, we see a similar chart, but for provinces, and you can see here that there's not a lot of differences between provincial labor market activity. This is really a reflection of the fact that this is a global and national pandemic, is that COVID cases have risen, shutdowns occurred, or at least partial shutdowns, and sectors are still hurting across those that you see on the left. But what is different here is that BC and Ontario, you see Ontario is actually one of the poorer performers, similarly to Alberta. Well, these also reflect the various measures that have been in place to stem the virus, for Ontario at least. Alberta is also taking a hit from a very weak energy and energy sector, which is facing very little levels of investment right now. But overall, if we look at these overall numbers, they are generally consistent with each other. Again, a reflection of the fact that this is a broader economic shock right now. And while the economy is, of course, rebounded and it has recovered quite a bit of lost momentum since over the third quarter, if you look at the next slide, this is still a very, very weak economy. When we look at this through the lens of past peak employment cycles and where we are, the fact that we went from a 15% drop off in employment and now we're only at about a 4% drop off relative to February, it sounds great. Sounds like we've regained a lot of those jobs, but we're still down by about 630,000 odd jobs from where we were in February across Canada. And if we look at this through the lens of previous economic cycles, well, at this point, we're still well below where we would normally be in a recovery period. Essentially, if you look at the numbers from 2008, for example, employment is still below the trough of the 08-09 financial crisis. So we have recovered, but it's still in a very deep and sort of a dark period for the labor market. The one aspect of this is that the next slide is that there's been a lot of federal support and provincial support for the economy during this period. It's unprecedented. It's really a reflection of that governments recognize that they also needed to provide a lot of fiscal support if we're asking or companies to shut down. There would have been various closures regardless of the pandemic response from the government in terms of requiring closures, as consumers would have shied away from stores. They wouldn't have gone out anyways. But the government recognizing that there needed to be some support for households during this period has driven the various programs such as the Canadian Emergency Response Benefit, the wage subsidy programs, the employment benefit accounts for, the emergency benefit accounts for businesses as well. This is driving, of course, about likely around a $350 billion deficit this year for the Canadian economy, but it's really a requirement. I think it was a necessary type of a spending given the state of the economy and where we were headed in the spring. As we go forward, some of these policies have already been transitioned or are becoming a little bit less less generous, but overall we still expect to see these types of programs being in place through most of 2021. And just going back here to our next slide, is that, again, just sort of underscoring the K-shaped recovery here, is that when we look at the employment recoveries, what you see is that low-wage employees have been hit the hardest. They have seen the sharpest decline, and they still haven't fully anywhere near recovery relative to pre-COVID levels versus high-level or high-earning employees, which are actually have seen no net job losses from the labor market. We're also seeing, in terms of the current environment, is that, like I said before, that we have recovered, but it's still exceptionally weak. So the next slide here shows how small businesses are faring at this current time. And this is actually before newer measures have come into play for, let's say, Ontario. And Alberta will probably be imposing more measures as well. But even in early November, and with recoveries and reopenings, what we did see is that overall businesses were generally sitting around 60 to 70% in terms of full reopening of from where they were in the pre-COVID levels. Also, businesses at or above full revenue, very few were sitting below, were at normal levels of revenue. So really a reflection of an exceptionally challenging business environment that persists even now for businesses, which likely in the short term will be getting worse, unfortunately. Another key sort of a data point here in the next one is that we've also seen some impacts in terms of the population growth cycle. If you look at the next slide, please, what you see is that growth in terms of seasonally adjusted population growth was essentially zero in during the second quarter. This is not unexpected. This is the fact that, again, borders were closed, there was no international migration. But again, it is a key driver in terms of consumer demand and also labor market supply as well. But we did see almost no gains in the second quarter, and that's going to continue through the third quarter as well. So overall, I think the current picture right now is, again, it's one that's showing improvement or has shown improvement through the third quarter. But as we sort of move forward, there's a lot of questions right now. What happens next for the economy? What happens in the winter? What happens in first part of 2020 and first part of 2021 as well? And so what is next? The next slide. The fact is that we don't really know exactly what's next. We wish we had a very clear crystal ball, but as many forecasters would probably agree, the pandemic has kind of thrown everything out of whack. The normal type of a economic recovery is not in play because it's a very different type of a downturn as a health crisis, more so than a normal economic recession. But what we do think is that there will be the winter of discontent in the next slide. We were already expecting that this would be a fall stall, that with the fact that temporary measures support businesses like patios, those would be less effective in the winter, of course, so we wouldn't expect those to be a key driver of that business for some of the hardest hit sectors going forward. The domestic tourism that some areas of the provinces were experiencing, well, again, that's kind of been shifted to the side as well, especially as kids go back to school. So there was no doubt in our mind that this recovery phase in the third quarter would give way to a much slower level of growth in the fourth quarter. That when we add to that, though, is that when we look at the businesses that were already operating well below capacity, it's kind of said to us that we would likely see more business closures, firms not being able to make their rent in some cases as business slowed down. But what's really driving, I think, our view that discontent for the winter is wave 2 is fully in play for COVID-19 right now. I think a lot of people were hoping, I think I was obviously, that our ability to wrestle down the COVID-19 pandemic during the summer months would give way to a relatively stable winter, but that's clearly not the case. And right now, in terms of 2021, it's really, in our view, going to be shades of 2020. It won't be the same. I think that we are getting towards a period in which the economy will start to get full recovery in partway through 2021, or at least in terms of the growth cycle. But overall, we're going to be facing the same similar patterns of low tourism. Government support is going to be in play. All these events and types of social gatherings are still going to be very limited in play. And if we look at the data, at least for the next slide, is that this is largely being shown already. We've already seen that this is a little bit dated, October data from Export Development Canada, their Canadian Economic Recovery Tracker. It was already showing a rolling over of economic activity during October. And we also saw in terms of some of the data that was coming out of the banks that looking at transaction data, that growth in sales activity was already following to about the 0% year-over-year growth phase. Again, that's consistent with that slowing of the economy. And of course, with the next slide here is a big kicker now. The date here that I have on your slides is October 9th. That's incorrect. It's actually, I think this is November 20th data from what I recall, is that those COVID-19 cases have surged across Canada at this point. We are now seeing, of course, record Alberta counts, near record BC counts, Ontario counts. And of course, this is also has driven massive levels of restrictions across Canada right now. We know that Manitoba has entered the red zone, which has severely restricted their retail. Ontario similarly has restricted their retail and a lot of other restaurant services as well. BC has implemented more social restrictions, not quite to the same extent, I think, as other provinces. And I would expect to see some more, given Alberta's numbers, that more restrictions are coming forth. And when we think of this through what this means in terms of social restrictions and economic restrictions, the next slide is that the growth cycle or this growth recovery will at best, that's right, sorry, thanks. The numbers will at best be flat, and I think this is Bank of Canada's outlook. But the reality is that this was taken before a lot of these measures were put into place. And we will be looking at a negative print for the GDP in the fourth quarter. Again, as consumers have to pull back, businesses, investments start to pull back. And I'm very concerned, of course, that these retailers who are kind of banking, who typically bank on the fourth quarter period for their holiday sales, are going to have some real challenges going forward. I guess the offshoot is that they are receiving more support now from the government through various commercial rent relief, and that should hopefully help in the interim period as they lose their sales and are generally hoping to maintain above water. Sounds terrible. I admit that the winter months and even into 2021 is going to be a very challenging period. Again, we're wrestling with the pandemic and what it means. If we can wrestle it down enough that some of these measures are lifted, but it's this for the next period, for a little while, it's really that dancing with the virus aspect. You kind of hit it down as much as you can, and hopefully you reopen. And at least in the positive, though, is that going forward, is that better times are ahead. In the next slide here, we are seeing an imminent release of a vaccine. In fact, if we look at Pfizer, BioNTech, Moderna, AstraZeneca, and also in Russia, there's another Sputnik V. Those have all shown very strong trials for the vaccine. And this suggests to us that by early 2021, there will be a vaccine made available to the market. It's going to be some time before deployment occurs. Those high risk will, of course, be the ones who receive the vaccine first. There's questions about logistics of deployments, as well as how long these vaccines will last, and also how many doses are needed, for example. But again, I think the key here is that there is a vaccine in play, and it will be in the market and I think will be fully deployed by sometime in the second half of 2021. That does mean that markets are already pricing this in. They're pricing in higher growth going forward. They're looking at higher investment spending, I think, past the pandemic as well. So this is a very good news story for us getting into more of a normal by partway through 2021. But it's pretty clear that we first have to deal with the present first of the current COVID spread. And if we look at what this means for our economy here, we are looking at the economy, next slide, please, is around a 6% contraction in GDP this year in Canada, before around just over 4% rebound in 2021. There's still going to be a lot of slackness in the economy. So even though we sort of get to that vaccine stage, that lost output that we've seen in the last year, over the last year, and the fact that we aren't going to get back to pre-COVID levels probably until late 2021, early 2022 in terms of GDP, just because we need a vaccine to really get tourism back on track, and that will take time. You need that for accommodation, food services. That also means that interest rates are going to remain very low as you go forward. I think into 2023, we'll have policy rates, or Bank of Canada's overnight rate will be roughly around a quarter, which is where it is now, although longer yields will start to pick up as well. We do expect to see, though, that in the next slide, that immigration will pick up. 2020 is largely driven by the pandemic, of course, and closed borders. The government is already the federal government is already looking to drive immigration higher to make up for that loss, for those lost number of individuals who would have come in the absence of the pandemic and border closure. So we would expect another boost coming from that immigration cycle. So overall, I think that kind of concludes where I want to talk about is that where we are now is very difficult. I think we should all admit that small business is difficult. Those who are in the sectors such as accommodation, food services, tourism, events management, those are all in difficult situations that will continue into 2021. But things will get better. We do expect to see that vaccine in play, and that will help to drive the economy, rebuild a lot of the lost jobs. But this also says to us that during this interim period, and until we have a vaccine, what's very critical is that we do support small businesses and business in general. Why? Because you lose those businesses in the interim. You also lose their capacity, and it just makes that recovery so much harder. There won't be as many jobs available if they shut down as well over the longer term. And also, again, for workers, for employees, there's going to be a lot of skill loss in that type of environment as well. So yeah, so we are cautiously optimistic of where we are right now. So I think in terms of your poll question at the beginning, bang on with what our view is, and we are hoping for a better time in 2021. So I'll hand it back to Mike. Thank you.
Thank you, Bryan. Just tremendous insights, data, and an assessment on the economic landscape. We all know that change has been constant through 2020. When looking at hiring trends nationally, we have seen a small deceleration for new employment in October over September, but there continues to be that cautious optimism in the air, with unemployment stat steadily declining for the 5th consecutive month. Now, when you specifically look at specialized roles in demand positions within accounting, business, and administration, our national average is actually sitting at 4.9%. So many on this call in the audience may be asking, what does that actually mean for hiring as we head into the latter part of this year and also into 2021? The pandemic has caused business disruption in 2020. And it's quite ironic that technology was not actually what caused that disruption. If anything, technology is now accelerated, and we are seeing that investments are being made around technological upgrades as a key business priority. Many ongoing digital transformation projects with our clients are connected to client data security, virtual internal communication tools, and other projects that tie to business continuity and hybrid work models. So this is a great segue, and it leads us to the second poll question. So when considering how to best accelerate your business in 2021, which of the following areas do you feel is most critical to invest as a business? So the first option is ERP system. Maybe it's a CRM, so customer relationship management tool, an internal communication tool. The fourth option is data and security, or data analytics and BI tools. We'll give it a few seconds for everybody to enter their answer. All right, let's share the results. So 46% share data analytics and BI tools, and 20% made up of internal communication tools. What we have seen is that, interestingly enough, the internal communication tool was a massive investment as we first entered the pandemic. And now people, as they are working through the recovery, they're looking at ways to invest into their business. All five are really key critical parts of organizational investment as they pivot into the new year. Next slide, please. Since the pandemic began more than 8 months back, and with the second wave in full swing, we talked about the restrictions and advisories have caused many companies to just rethink their human capital strategies and put contingency plans in place. The good news is that many organizations have been resilient and agile through the crisis and have been able to adapt by pivoting. What's more, recently we've seen companies are being really selective when hiring employees. Job seekers must be ready to search and compete for these opportunities, and many also have to prepare and consider remote work options. Now, the good news is that the pandemic has led a rapid rise of remote work, and this is a trend that's likely to continue post-pandemic in some way, shape, or form. We can move to the next slide. So COVID-19 has changed everything, including how companies recruit for talent. Now, if you're hiring for a critical position in today's work environment, you need to really reimagine your hiring process to land that top talent. According to one of our recent surveys, more than 600 managers that were surveyed under this, 44% actually shared that their organization has hired full-time or temporary staff remotely since the pandemic began. Many businesses have adjusted their recruitment and hiring strategies to attract top talent, making changes to the way they hire due to the pandemic itself. And the ability for many jobs to be performed outside of the workplace has given employers a unique opportunity to extend their candidate searches well beyond the typical geographical boundaries to access a much deeper talent pool. As Canadian labor market evolves, and organizations position themselves for a further recovery, this will be an important strategy for organizations looking to fill in-demand roles in specific, hard-to-find skill sets across the country. We talked about the fact that we don't know what the future holds, but one thing is for certain, even after the work-at-home advisories and some of these restrictions are lifted next year, some or all the hiring trends that you're seeing on the slide will continue to a degree. What was interesting, but not really surprising to see, was that 3/4 of employers conducted remote interviews and onboarding sessions. This will continue to be a common trend, especially when we see COVID-19 cases on the rise in many of the markets across the country. What's really key is having an efficient, thought-through plan around the hiring process and ensuring that you have the technology and the process in place to really attract and secure the top talent. Because what we also seen is that counter offers is on the rise. Furthermore, the onboarding of new staff has never been more important than today for retention. In some of the divisions right across the country with Robert Half, up to 80% of the job orders and engagements coming in have the option to actually work 100% remotely. This means that clients are showing flexibility and creativity needed to remove geographical boundaries to find the best possible person without those restrictions in place. Next slide. 2020 has been tough for many of us, whether it was temporary layoffs, furloughs, pay cuts, brief office closures, even mandated use of vacation days. We're seeing that many employers are worried about keeping their top talent. We've also discovered through our research that retention is a concern, with 8 in 10 managers reporting that they are worried about retaining valued employees. So let's look at 2 or 3 factors and reasons for this. One of the main key attributes is that we've seen a lower employee morale due to the crisis. We're also seeing an increase in burnout stemming from the need for workers to take on more duties due to maybe layoffs or furloughs, but also juggling personal demands, whether it's kids at home, elderly dependents, or other personal demands that come up. And we also seen that some clients out there also have had to cut salaries or put a hold on some raises as well. So this is all comes together in terms of being a really challenging time for leaders. Now, on the flip side, when employers are intentional in hiring under today's climate, they're actually putting a premium on professionals with the skills and expertise needed to support new business priorities resulting from the pandemic. So even in a time of higher unemployment, a majority of companies are offering new recruits pay that meets or actually even exceeded pre-pandemic numbers in some cases. More than half of the senior managers that were surveyed said that salaries for new hires have held steady since COVID-19 began. About 1 in 5 respondents also shared, as you can see, that there has been an increase in their base compensation as well. Next slide. Now, let's switch things up and take it to the employee perspective. People are rethinking what's most important to them and their priorities. What the pandemic has shown, it's given everyone time to reflect on what's really important for them. It's been an opportunity to reset. 29% want to pursue a more meaningful or fulfilling position. People want to be able to tie paychecks to purpose. What we also found is that moving forward, 43% will prioritize their personal life over their job, where traditionally they may have put their career first. And then the third point is that 60% are more motivated to work for an organization that truly values its staff during unpredictable times. The bottom line is that there's so much uncertainty and unrest. People will naturally question their priorities, whether the company's whether their company's values actually align with their own. You know, this is a really key turning point when you're looking at the challenges that we're going to be facing until a vaccine is in place and until we work further through this recovery. Employers should really use this opportunity to reinforce to their team the company's mission, contribution to their employees, and the community that they actually serve in. Continuing to be responsive to employees' evolving needs will be critical to retaining valued staff. And leadership today through empathy, kindness, trust, and emotional intelligence has never been more important than today. Next slide. So one of the many ways that leaders have been able to support staff is with flexible scheduling. You know, this was already a popular perk pre-pandemic, but COVID has now turned this to a necessity. The pandemic has popularized a familiar part of flexible schedule and really gave it a catchy name, which we call windowed work. This is when employees break up their day into distinct chunks of business and personal time, really alternating them rather than working the strictly 9 to 5 shifts and the prescribed times for lunches and breaks. 3/4 of office professionals surveyed in Canada actually share that their job allows for windowed work, or their ability to actually break up their day to those chunks and splitting up that business and personal time. Now, from those respondents, nearly 2/3, so 64, shared that their arrangement has actually led to greater productivity. Optimal and productive work hours don't look the same for everyone. As one option for greater flexibility, windowed work arrangements allow companies a tangible way to help their staff better balance professional demands along with their personal commitments. So by giving employees that freedom to choose where they work, organizations can actually offer a greater control over their time, productivity, and ultimately their overall happiness, which is key. So let's go into the next, and it's a great segue to our final poll question for today. And the question is, what is your greatest staffing challenge at the moment? First option is hiring skilled professionals, retaining top performers, improving morale and productivity, so tying to culture, and finally, adapting to the hybrid remote working models. All right, we'll give it a few more seconds. Okay, let's see the results. So improving employee morale and productivity, almost 50% of that. And 24% was adapting to a hybrid remote work model. Interesting. Yeah, both have been a tremendous challenge just in terms of how people are feeling on a day-to-day basis. People are finding new and motivating ways to get people productive and ensure that their morale is up. You also have to take into consideration that there's many leaders that have never managed remote teams. So this is a whole new learning for many leaders in businesses across the country as well. So let's go into the next, and I will facilitate a little bit of a Q&A, see if there's any questions that have populated. All right. Let's go with the first question here. And Bryan, this question is for you. Do you think that business and personal taxes will rise to pay for the government subsidies, and what impact will that have on the recovery?
Yeah, so I think at this point, I'm not too concerned about increased taxes, especially during the pandemic period. There much of the deficit that we're looking at right now, although it's very large, it also rolls off once the economy recovers. I think that when we look at this through the lens of, how do we get to the next stage or sort of recovery, CERB or the various programs, EI programs, they all kind of roll off with the recovery itself. We also have to remember that we're in a very low rate environment. So at the very least, it's kind of affordable that we're not paying large levels of deficit financing in terms of the costs related to it. But overall, if we go forward, a year, 2 years in the future, it's very possible we could see some increases that we do want to get back to. I think at some point a sort of a balanced budget across Canada as well. But at this point, I'm not too concerned about it. But we will see some. I think we will see some hikes at some point. And then that will be the similar across governments around the world, but offset by the fact that things are affordable in terms of the interest rate environment, and that's not going to change for these next couple of years.
Thank you. Yeah. The second question that was put out there, and love your opinion on this, Bryan. I think that the government is certainly trying to balance the challenges of COVID-19 and ensuring that the economy is still seeing that positive momentum. Do you feel that there's a chance that there will be a full office closures across the country at some point?
No, I think number one, a lot of companies have already moved in that direction, in whether it's 70% or 65%. And in fact, if you look at Ontario and even in BC here, they've essentially told, or at least recommended, that employees or that employers keep their staff at home for until the pandemic or some of the worst passes. So a full-on required closure, I don't think that's necessary. I think that there would be a lot of workplace requirements that firms themselves will make that decision as well. Going forward though, in terms of business closures, I think there will be a rebound in office demand as we move through into 2021. My view is as much, we were talking about remote work and sort of that shift. The office isn't dead. It may be repurposed. It may be more for various components of work, whether it's strategy, team building, things like that, with some hybrid type of an environment. But I do think that a lot of firms will want their staff back in the office when we hit sort of that vaccine phase. I think a lot of good work gets done at the office that you lose when everybody's in a remote space.
Yeah, those are great points, and I do agree. I think that there's a bit of a gap. I think there's a lot of good things that have increased in terms of collaboration and leadership and working remotely, but people are also missing that human connection and some of the collaboration that is done in person. So finding that balance and hybrid approach might be a way of the future as well. The next question out there for you, Bryan, is what is your opinion of the effect of COVID-19 to the very long term on the global currency? With businesses decreasing along with their developments of AI and cryptocurrency, do you see that this is potentially a start of a currency consolidation or even demonetization?
No, I think that in terms of where the cryptocurrency, of course, has been something that's been occurring, or at least has been talked about a lot in the last couple of years. We also know that central banks themselves are sort of looking at cryptocurrencies because there is a less use of cash in itself in the economy as we kind of go to more debiting and Visa, those types of electronic transfers. A natural segue might be going forward is that they will introduce their own cryptos or their own digital currencies going forward. And I think that they're already looking at that. So, are we talking about the cryptos that are outside of the central bank system? I think that it'll be usurped by central bank cash and if it does move in that direction, we will see more cryptos from the banks themselves.
No, I appreciate it's a good one. I'll combine a couple questions for you, Bryan, and it's connected to the real estate market, which you obviously have a tremendous amount of experience in as well. But what is your outlook for the housing market in particular? Would you say that there's still cautious optimism, and where are the recovery trends in 2021, should be 2021, going above the pre-pandemic levels in line with the expected credit losses?
Okay, so in terms of the housing market themselves, it's been very strong across Canada. It's not a BC picture or Ontario. Prices have been up sharply in 2020. Really, when we look at the drivers of this, it's been, as much as we saw substantial unemployment that emerged during the COVID-19 pandemic, a lot of those, as I mentioned before, is that it was very much a K-shaped type of environment where lower wage earners were hit the hardest in terms of the labor market, while mid to higher wage earners generally didn't see much of an impact on their employment. So they've been kind of sheltered at that end. We've also seen the combination that because there's been so little options to purchase anything else in that people want to purchase, the travel savings have actually ballooned during this period. So the drivers of the housing market thus far and the strength have really been the fact that mortgage rates have been so low, very little, or if they've come off so much, they've seen steady employment for those who are purchasing homes, as well as those key drivers. When we look forward, some of these are likely to persist. I don't think that the mortgage rates are going to be. They're going to start picking up, I think, as we move in through 2021 or probably late 2021. That'll put some brakes on the housing market. Higher prices will be putting some brakes on affordability. My bigger concern, or at least one of my concerns, is about what we've seen during the pandemic, which is a shift in consumer preferences. They've a lot of households have looked for larger homes, looking at it through the pandemic lens and saying that they're working from home, they'll be remote, or they're not traveling, so they need more space at home. My only concern about that is that people make decisions based on the current situation. While a year out from now, when skies reopen, economy gets better, businesses want employees back in the office, what type of a shift or type of adjustment will we need to see in that phase? But right now, there isn't much in terms of supply in the market. Very low rates will persist. So I think that at the very least, the demand will still be there. Prices are going to remain steady, but I think there are some negative risks here related to whether individuals either took on a little bit too much or made some choices that they thought were long-term choices, but instead were actually short-term whims.
Yeah, no, that's a great point. Now, last question, Bryan, for you. We know that the impact on small businesses and temporary closure. So how long can the BC government continue this, just in terms of what's happening, and just tying in how long do you think the government can actually support with some of these programs that are out there?
I think they can support these programs well into 2021 if needed. A lot of the heavy lifting right now is being done by the federal level. I think we're talking about BC government. So I will say that a lot of the heavy lifting is done through those federal programs. While provincial programs, they've been sort of operating the margins, providing various small business support. And again, if we're looking at, I think the question related to BC in some cases, but BC, generally speaking, had a very good fiscal situation heading into COVID-19, balanced budgets, surpluses, in fact. Other provinces, it's a lot more difficult for a province like Alberta, for example, which is dealing with the dual crises of both the pandemic, but also the energy shock and the lack of investment. So it makes it much more difficult in some other provinces as well to adjust and to maintain it. But if we're looking at BC and some other provinces, these types of and I will go back and saying that a lot of these policies are necessary. Your alternative is that businesses go bust, and you lose, and there's big long-term cost of that.
That's great, Bryan. So I'm going to put our contact information at the end of this presentation. If we want to skip to that, the next slide. But before we sign off, I again wanted to thank you, Bryan. It's been really tremendous collaborating with you. I've been a massive fan of your work, and really appreciate you taking the time this morning. I also want to thank everyone right across from across the country for taking the important time out of your day as well. I wish everyone a fantastic, safe, and most importantly, a healthy finish to 2020. And take care, everyone.
Thank you.